How can cash flow loans help you? Last year, a profitable UK business turning over 6 figures nearly collapsed. Not because it wasn't making sales, not because it wasn't growing, not because customers didn't love it. It ran out of cash, and it happened in only 43 days. Today, I'm going to show you how that happens, how a cash flow loan can save you in that exact situation, and also the one time taking one is actually a terrible move. Let's get into it. Here's the truth no one likes to admit. Revenue does not equal cash. You can invoice 80,000 this month and still struggle to pay wages next week. Let me ask you something. If 3 of your biggest customers paid you 30 days late, could you still cover payroll, suppliers, VAT? Most business owners pause right there. That gap between the money owed to you and the money in your bank account is where businesses suffocate. And that's exactly where cash flow finance comes in. A cash flow loan is a short-term funding designed to smooth out working capital gaps. It's not flashy, it's not glamorous, but it works. It's for survival and smart growth. With lenders like Fleximize, businesses can access between £10,000 and £1 million, sometimes within 24 hours of approval. Fast, flexible, and here's what makes it powerful. You repay over time, you can often repay early without penalties, you align repayments with how your business actually earns. The speed alone isn't the magic. The magic is the timing. Let me give you a quick story. A retailer spots a bulk stock opportunity, 40% discount if they buy now. Problem, £60,000 is tied up in unpaid invoices. They take a short cash flow loan, buy the stock, sell at full margin. That one decision could double their return, even after financing costs. Now let me flip it. An agency wins a huge contract, but needs to hire before the first payment lands. No funding, they delay, client walks, same situation, different outcome. So here's the real question. Are you using finance to react or to accelerate? Here's where cash flow loans genuinely help. Cover payroll during slow paying periods, stock up ahead of seasonal demand, upgrade essential equipment, launch marketing campaigns, hire before revenue catches up. And because the right business lender will structure repayments flexibly, so you're not locked into a rigid bank-style arrangement. But this is where most people make a mistake. Remember that business I mentioned at the start? Here's what nearly sunk them. They used short-term finance to cover long-term structural problems. They weren't just bridging a gap, they were patching a leak. Huge difference. A cash flow loan should bridge timing gaps, not fund consistent losses. If your margins are weak, if customers constantly pay late, if you're relying on funding every single month just to survive, the loan isn't the solution. It's the warning light that comes up on the dashboard. And this is the part no one talks about. So before you think about applying, ask yourself this. Is this fuel for growth or oxygen for survival? If you're considering cash flow finance, do this first. Map your next 90 days of cash movement, identify the gap, exact numbers, tie the loan to a specific outcome. Plan repayment against expected inflows. Don't borrow vaguely, borrow with intention. That's the difference. Remember that business from the start? They took a short-term, structured cash flow loan. Stabilized payroll, renegotiated payment terms, tightened credit control, and they're still trading today. So here's the question I'll leave you with. If cash flow is the lifeblood of your business, are you managing it or are you reacting to it? If you found this useful, hit like, subscribe, and drop a comment below.